Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Now, today, when we're recording this on October 17th, we are at a very, very uncertain stage for all the markets. We've got interest rate uncertainty, policy uncertainty, energy price uncertainty, two wars. It goes on and on and on. So, not to bring all the difficulty here, but I thought it would be very interesting to speak with Elias Erickson of 91 about how he finds quality, because that's something that a lot of people are looking for right now amidst all the difficulty. Elias is a portfolio manager and analyst at 91. He has both jobs. He is portfolio manager of the International Franchise Strategy and an alternate portfolio manager on the team's flagship global franchise strategy. He is also an analyst on the global equity research for the global quality equity strategies. Prior to joining 91, Elias was at Thornburg Investment Management and Dodge & Cox. He received his MBA from Stanford and his BS from Brigham Young University, where he was magna cum laude. So welcome to the podcast.
Well, thanks so much, Rob. You read the whole bio.
Yeah.
All right. It's good to be with you.
I've never actually met anyone who's a portfolio manager and an analyst.
Well, we like to keep our pencils sharp.
Yeah. Well, I'd like to start because you all have done some exceptionally interesting work into the financial services industry, which everyone on the podcast calls home. Mm-hmm. So where are you finding quality in the financial services industry today?
Yeah, that's a good question. And certainly, as you highlighted in your intro, it's a volatile time, an uncertain time. We always focus on the attributes that we think can drive long-term intrinsic value compounding, which for us, it's a focus on free cash flow per share. Mm-hmm. And this we think is the best metric. It's a tangible metric of economic productivity. And so when we're looking for businesses that have the capability to protect and grow their intrinsic value in periods of uncertainty, structural inflation, higher interest rates, we look across the attributes that will lead to that outcome. And so for us, strong balance sheets, high returns on invested capital, high margins, those sorts of attributes. And we can find those in a variety of sectors.
Mm-hmm. Well, you guys do an awful lot of digging, which is clear from the things that are on your website, the recordings and the written pieces. So can we talk a little bit about what digging got you in the financial services industry, where that got you to?
Yeah, sure. So I cut my teeth in the investment management industry at Dodge & Cox, which has a tremendously rigorous fundamental research process. And so that was a wonderful place to be indoctrinated as to how you both diligence the business and then communicate it in a professional setting. Mm-hmm. And so that's something that I've carried with me, and that's very cogent to what we do at 91 within the quality team. The average holding period for our investments is over 9 years. So the turnover in our flagship strategies in the low teens, in my international strategy in mid-teens. And so we're looking at things with a very long time horizon with a partnership perspective. And so you need to understand these businesses very well and go deep enough that you're able to discern real true guiding signal versus short-term noise. So we go as deep as we can to answer that crucial question about the sustainability of the economic progress of the business.
Right. I just want to inflate that for 1 second. So
sure.
Yes, for those of you who are maybe at the gym on the treadmill or something like that, he did say 9 years. That eclipses a lot of VC firms, private equity firms holding periods. Like that is a real long time.
Yeah.
So it becomes the due diligence process becomes the monitoring process, which becomes most of it, right?
Yeah, we are always looking to expand our opportunity set and diligence businesses that are exhibiting the quality characteristics that we target. And we think this flexibility is quite important because companies with producing the outcome we're targeting, they shift where they arise. We see more in emerging markets than we used to. We see companies within sectors that previously didn't exhibit these types of characteristics. We used to hold about 65% of the strategy, speaking about global franchise and consumer staples back in 2012, 13.
Okay.
And today it's a much lower percentage. And the reason is that the returns on invested capital for those businesses, because of the intrusion of endless aisle from e-commerce, mm-hmm. rising private label disruption, forced significant new investment by these businesses at the same time that they were experiencing pressures. So we looked and said, the forecasted economics of these businesses are declining. And at that same time, we found opportunities in Visa
at its IPO, was initially classified as an information technology company.
And also in Moody's and S&P, which are branded technology platforms that happen to do ratings for debt. And so these were pretty interesting businesses that exhibited our quality characteristics that we could underwrite for a long period of time. And that flexibility to shift and move as one opportunity set presents itself is, I think, a strength in preserving the prospective opportunity for our clients.
Well, I think this is really interesting to dig into a little bit. Let's focus on Visa for a second there.
Mm-hmm.
What were the things that really pulled you all into that? What were the factors that made it a better choice than Amex or MasterCard?
Okay. Yeah, so Visa is a great example of the type of company that we're looking for. And as I mentioned, the business came public in 2009. It was something that we investigated later on and added to our portfolio once we did our work. What Visa exhibits as a business is a combination of a very strong competitive moat, which is its VisaNet network, which is a multi-node network across merchants, consumers, and each of their banks. And it's very hard to replicate a multi-noded network that is as scaled as theirs. They have a super strong competitive position as the leader in these open networks, as opposed to closed networks like Amex and Discovery. And MasterCard is a close number 2, and that's a very cozy duopoly. And strong balance sheets, very low capital intensity for growth. And so their ability to grow at very high incremental rates of return is quite unique. Very high margins, or EBIT margins now are approaching 70%. And so as cash and check and other forms of antiquated payment media convert to electronic transactions of different sorts, Visa continues to enjoy those tailwinds. And it, from a moat, competitive position, and then business model strength perspective, we can have a lot of confidence in underwriting that over a multi-year time frame.
Okay. And when was that you started that investment, roughly?
It was before my time at 91. I think it was in 2014, 2015.
Okay. Yeah. So that has been an exceptionally interesting time for that stock.
It has been.
Yeah. It's going forward, when you're looking at a company like Visa, do you look at things like credit card charge-offs or the health of the consumer?
Yeah, so we certainly look at these things. We consider these near-term elements amidst the longer-term picture of these companies. So 2023, what we saw, or what was revealed, was that we had a much more resilient consumer than the market initially expected. Estimates of surplus savings from COVID proved a bit undercooked and had to be revised upward. And then we had strong employment, which has been really supportive as well. However, while a robust consumer environment has persisted longer than anticipated, I would say that the overall trajectory towards tighter budgets and weaker spending continues unchanged. So the direction of travel sequentially is negative. Offsetting this, Visa and MasterCard, while they're vulnerable, especially to travel, which is about 20-25% of each of their businesses, and travel is more economically sensitive than other categories, you do have some offsets, like growing conversion of digital payments. You have e-commerce share gains. You have penetration of low friction payment modalities like tap to pay. And then you have all of these attachment rates, which are rising for ancillary services like tokenization, security, and analytics, and things like that. And maybe the final point is that if you look at the valuation of these businesses, we'd note that they're trading more towards long-term lows, which reflects some anticipation, we believe, of these near-term, more cyclical challenges to the consumer.
Yeah, I thought this was quite funny. One of the members who went home to China for a recent holiday sent out a picture to everyone of while she was there, she went on a sort of boat tour of the river that goes by her town. Which had been for a while. It's a lovely, lush place, beautiful. And when it became time for her to pay for the boat, the person who was driving the boat pulled out a piece of cardboard on it that had all of the different networks that he was able to accept on his phone.
Yeah.
It wasn't more than Venmo.
Yeah, that's fantastic.
It was really a moment where I was like, oh yeah, this is like she's on a boat in the middle of nowhere.
Wow. Yeah, it's pervasive, and it's enabling all sorts of opportunities across the board.
Yeah. So, does your due diligence change when you are, you talked about FCF being a big part of it, but does your due diligence change when you go to even, some of the other OECD countries or the less developed markets? And do you do anything in the frontiers?
We do. As I mentioned in the beginning, we try to evolve toward the opportunity set that meets our criteria over time. And so what we do see is that there are more companies, some of which are copying Western models, some of which are meeting, native needs in their domestic markets that have the characteristics we're looking for. And many of these have borderless opportunities. And so you can find an emerging market business that can expand well beyond its small domestic market and become a global champion. So we do pay attention. For us, we've thought that on a risk-adjusted basis, it's been better to take advantage of some of these very exciting emerging market trends, rising GDP per capita, GDP profiles that are shifting more towards consumption, by investing from the sidelines, or fishing from the sidelines, if you will, owning companies that have very strong emerging market positions that are structured in a developed market and run in a developed market, governed and have transparency requirements that are developed market based. So companies like Hermes that has 45%, 50% of its revenues coming out of Asia. Reckitt Benckiser, Nestle with significant businesses in India and other emerging market regions. And so we still can get the benefit, but avoid some of the volatility associated with being listed and domiciled in a developed region.
Yeah, and the due diligence benefit of understanding where the numbers are coming from and all that kind of
transparency is really important. Best practices from a governance perspective, reporting, all of these things are really important for us. Accounting standards, of course, for the quality-oriented strategy are very high. And so, these sorts of things are more commonly found and better trusted in a developed market setting. But as I mentioned before, the opportunity set is expanding. And so we're excited about some of the things that we're seeing.
Yeah. I mean, when you think about that, your opportunity set is expanding is kind of an understatement. It's probably exploding.
Mm-hmm.
How do you guys handle that from a due diligence perspective? How's your department structured?
Yeah.
How do you all bubble up ideas or bubble them down? How does that work?
Yeah. So we have 12 people on the team. Everybody wears an analyst hat. We have a very well-structured research process. So we have analysts and PMs that sit in 3 different offices in New York, Cape Town, South Africa, where the business was founded, and London. And we think that this is a benefit because we have people that were born and raised in very different economic settings, emerging market settings, developed market, UK, EU. And so we have this diversity of perspective, which we think informs our debate. And then also being distributed helps us to avoid groupthink.
Right.
Sometimes we wish we had a little bit more consensus that was built, but it stayed, that challenge to debate aspect of our process is very robust. The way that we process ideas, we have 5 portfolios that we run along this investment philosophy. Each has about 30 holdings, and the turnover across these strategies is quite low. Mm-hmm. And so for each strategy, you think that you've got 3 to 4 new purchases and sales each year.
Okay.
And so we calibrate our research throughput according to those types of demands.
Okay.
And we'll fluctuate it so that we're seeing the right kind of ideas and still maintaining our research standards so that we can hit the performance targets that we have set for ourselves.
Right. Yeah. It still sounds like a mammoth task for that many people. Plus, you have a bunch of English speakers who are separated by a common language.
Yeah, you're right, Rob. It is a monumental task, but it's one that we find exciting. And as we think about how to approach it, we look to optimize across two different vectors. One is just how many ideas we're looking at, the throughput of ideas. And then the second, which is even more important, is the relevance of those ideas. And since we only run 5 strategies and they're high conviction strategies with low turnover, we don't need that many new ideas to meet our performance requirements each year. So, and also we have some overlap across these strategies, right? Which adds some synergistic elements to the research that we do. So we think about these parameters in terms of throughput and whether it's sufficient. But getting to the most important thing, which is relevance, this is where investment philosophy clarity is critically important. So we're quality oriented, as we've discussed already, but by being really clear about what we're looking for, we're also very clear about what we're not. And so it's able to very quickly narrow the universe. And by being really consistent and clear about what we want to find across our team, we're able to increase the relevance of where we spend our time. So for us, we can focus very quickly on the promising opportunities and those areas where we find the attributes that we target. And then in our process, we have multiple checkpoints where we're able to review and debate whether we're finding these attributes and whether they meet our thresholds, so that we can weed out weed out the weak ideas and prioritize the best ideas. So being ruthless about our philosophy and our criteria, being very clear about what we want and what we don't, it takes this very large task and it winnows it down to something that's manageable, and something that we're able to approach with some success.
Okay. Now, going forward, I thought it was interesting that you mentioned, it sounded like one of your portfolio companies was Hermes, which has undoubtedly benefited from the unprecedented impact that the Chinese upper middle class consumer had.
Absolutely.
On the luxury markets. The explosion of resorts in Southeast Asia.
Yes.
That are 4-star plus. It's just amazing.
Yeah, very nice.
As you look forward, do you see factors like that are you anticipating bigger trends that are coming up?
With Hermes specifically, or maybe speaking first to the luxury sector, this is a structurally growing opportunity. With some negative consequences, there continues to be trends towards a bifurcation.
Yes.
Along socioeconomic strata,
yep,
which supports both conspicuous consumption and also what some of the luxury companies like Hermes are probably better defined as doing or described as doing, which is some piece of self-actualization, people's identity, how they express it. And so it's interesting to see these very expensive handbags without clear markers to the undiscerning eye as to who manufactured them and where they came from. So that conspicuous consumption piece sort of falls away and it becomes more of a self-actualization argument. So we're, despite the cycle, we've got a massive post-COVID boom, which is now normalizing in the luxury space, and multiples are compressing in appreciation of that. But we're still very positive on that long-term luxury journey. And Hermes rides pole position to that and has somewhat of an asymmetric exposure because they do cater to the ultra affluent, which is a more resilient customer base.
Yes.
And then they have multi-year wait lists for many of their products. And so they have this more defensive characteristic profile, while they still benefit from this very long-term growth opportunity. And so, we're quite positive on that. And it's the asymmetry of the growth exposure with the more defensive attribute that makes it interesting for us.
Yeah, for members who maybe haven't paid a whole lot of attention to the luxury market, what they have done is basically boxed up and stored demand.
Yes.
It's incredible what they have done. I wish I had thought of it.
It's the paradoxical balance of supply and scarcity, growth and scarcity. And with Hermes, because their product manufacturing process is still artisanal, it's handcrafted.
Right.
The way that they roll out new capacity is by training individual craftsmen, craftswomen. And so they have to do this with a lot of lead time. There's an education process in addition to creating the space. It's much more challenging to do. than to just open a new factory that's going to print out a bunch of widgets. And so they have these wait lists, excess demand, but the supply has to come on in a very ratable fashion. And so you get some real visibility as to how that demand will be met, what that means for revenues and growth, and the sustaining of the financial model of that business.
Yeah, it's exceptionally interesting how they've affected the old supply-demand curve that we all learned.
Mm-hmm.
So, well, perhaps we can leave it there. Elias, thank you very much for being on the podcast.
Oh, you're very welcome. Thanks for having me.
And thank you all for listening. So our next podcast area we're going into for the end of the year here is going to be on energy and some more ESG topics. So I look forward to seeing you all there. Until next time, I'm Rob Rowan, and this has been Compound Insights.